Now, our trade strategy. Someone asked me on Twitter about position sizing. Now, I'm probably not the best at this, okay? This is my disclosure. I have never been the best at position sizing, but I can give you some ideas that you can work with, okay? Before we get to position sizing, we've got to talk about account size. Now, one of the biggest mistakes I see a lot of young traders make is they don't understand what a right account size is, okay? Now, the first thing you have to say to yourself is, what are you trading? Right? If you want to know what account size you need to say, what am I trading? So, am I trading an underlying share? Am I trading a futures product, a leverage product? Am I trading a CFD? What am I trading? Okay, because leverage products, obviously, by the definition of leverage, you're going to require an account that can potentially take bigger drawdowns. Right? If you're trading the underlying, okay, you're not going to have as much volatility and drawdown. Therefore, your account size can afford to be slightly smaller. That being said, as a rule of thumb, I like to work on the concept of 20 big blinds. Okay, for a trader that's established, they're consistent, you should never, ever, ever blow out an account with 20 big blinds. By 20 big blinds, I simply mean you can afford to lose, 20 days in a row, the risk you set yourself, and then your account is wiped out. Okay, so call it i.e. 5% a day. So as a rule of thumb, for me, I set a 5% rule a day. But again, that comes down to what I trade, which is futures. Okay, if you're trading something that's slightly less volatile, well, then you can afford to maybe go 5 to 10% down. I.e., why? Because you need to risk more in order to make more. Okay, then also very important, what is your objective? Okay, one of our traders that's constantly on Skype, he's an elderly gentleman, and he said to me, I said to him when he set up his account, I said, what do you want to achieve, or what is your purpose of trading futures? And he said, look, I just want to make 200 quid a day. I said, okay, fine. He's retired. He's living on a retirement. He's bored. He's got nothing better to do. He just wants to make 200 quid a day. So I said, okay, well, fine. If you want to make 200 quid a day, you don't need to put down more than £5,000 in an account. Okay, so your account size is very dependent on what you want to achieve. For me personally, I want, to be able to go on lavish holidays. I want to be able to, do cool things and experience cool things. So my risk nature is very different. My objective is to try and, quadruple and tenfold my account every year. That's my objective right now. Therefore, I need to manage my account accordingly. Okay, so what is your objective? Then last, what is your strategy? Okay, again, so important. It's not a hard, fast rule of your account size. It's based on what is your strategy. In other words, if you're someone that's very much a breakout trader and you get stuck in very, very volatile markets, you'll need a different account size to someone that is maybe sitting in value stocks, maybe capturing yield, maybe capturing dividends. Okay, so it all depends on those factors. Now, position sizing is different to account sizing. Account sizing is how big does my account need to be for me to run a successful trading operation or trading business. Position sizing is the day-to-day trading. On every single trade, you need to allocate a portion of your risk. Okay, and that's why I've spoken about account sizing first. If you don't know what your account size is, if you don't have the correct account size, you are never going to be able to manage your position sizes correctly. Right? So let's say for all intents and purposes, your account size is £2,000. Okay. In fact, let's make it a little bit bigger. Let's say it's £20,000. Let's add a zero. Now, you're a futures trader. What I would suggest if you are trading futures, I would never recommend trading futures with less than a $10,000 account. Okay, simply because it's a leverage product. Right? You're never going to be able to learn the game with an account smaller than $10,000. All right. Now, in terms of once you've got the account size, let's say 20,000. You need to, on a rule of thumb of a 20-day big blind, you need to be able to lose up to $1,000 or pounds, whatever it might be, on a day-to-day basis. Okay? In other words, 5% of your account size. Now, once you know what your daily risk allocation is, then you can start to look at position sizing. Because if you know that on a day-to-day basis you can afford to lose £1,000, then on every single trade you can start to say to yourself, well, is this a high probability trade? What's the risk reward, etc., etc. Now, some of the factors to consider with regards to position sizing, first is obviously account size, like I mentioned. Then the factor of risk. Okay. Let's say you are trading Bitcoin with $1,000 risk on the day in the future space. Okay, that is never going to work. The same if you're trading, for instance, the German DAX. Okay, you cannot afford a thousand euro stop on the day or pound stop on the day if you're trading the DAX. Why? Because it'll take simply one or two trades and you'll be finished for the day. right? So you need to consider, can you actually trade a market based on the risk of how it moves around? All right. Then you need the invalidation. In other words, and this is really, really key. Position sizing, what's very important is your stops. Okay. A lot of people say to me, yeah, but where does the stop go? A stop goes where a trade is invalidated. Okay. So it's no longer a valid strategy. So again, the size of your position depends on the size of your stop. Okay. Now, why this is very, very important as well is a lot of people, if you go through the Twitters and you go on, all these, wonderful gurus and all that, they're always talking about these 30, 40, 50 pip stops. And I scratch my head and think to myself, that is definitely not a leveraged position. And the reason I know why is because if you do some basic mathematics and you take a one lot in the euro dollar and someone says, I've got a 50 pip stop, that's a $5,000 stop. Okay. Now, for me, that will never make sense. You don't need to take a 50 pip stop in a leveraged product, okay? By definition, leveraged products are all about timing, and we'll talk a little bit about timing now when we go through, the trading technologies price ladder. Okay, so again, just make sure that you're putting stops where a strategy is invalid. Okay, now. Again, is the product leveraged or not? Right? If you're not trading a leveraged product, you won't need as much risk as you would if you're trading a leveraged product. Okay, then risk reward. Right? How much reward are you getting for how much risk? If there's a golden opportunity and you can make 4x or 5x or 6x, whatever it might be, then it might be worth taking on that risk. Okay, putting on a slightly bigger position because you're getting the potential reward. Right, and then lastly, the probabilities, and this is the real key. This is this is what I'd say almost every successful trader I've ever come across is really good at, and that's what I'm referring to in the sixth gear mention here. Okay, very good traders that trade leverage products, when the probabilities are in their favor, they can move into a sixth gear. What I mean is, they can almost over leverage. Right? So what they will typically do is they'll take that entire day's position. So we spoke about how much are you willing to risk on a day? £1,000. They'll take that entire £1,000 or whatever their account allocation is, and they will risk it all on one trade. Why? Because the probability of outcome is very, very high. Okay, so I hope that answers your question, the gentleman that asked all about what's the right account size, the position size. The simple answer is there is no right. Okay. What there is a number of factors for you to consider based on your own situation. Okay, but do not neglect thinking about this, okay? If you've got the wrong account size, you are already putting yourself in a very, very weak position. If you're risking too much or too little per trade, you're wasting your time, okay? Or you're potentially risking too much. So you have to consider these factors. You have to get these factors correct in order to ultimately give you some form of longevity.